The desire is clear, right? Because this has been a really high-performing area. We do see high valuations. What's the risk here of moving into some of these areas, which have been kind of popular as well in 2019? Are we worried about quality?
Right. At this point in the cycle, investors definitely want to look for those sort of up in quality trades. There is a lot of concern about just leverage overall in the cycle, and so investors are being very picky. They want to invest in companies that are paying down their debt, really committed to doing that, and kind of avoiding some of these sectors like oil that maybe have a little bit more hair on them right now.
What are some of those structured products that they're liking? Because I'm seeing some whole business securitizations as well. What do those entail and why are they so popular?
Right. Investors are really going for some of the more unusual structured assets. Whole business securitizations are very popular. They're basically a way that a franchised restaurant can turn those franchise agreements and those payments into a bond. A lot of investors that also look at corporate bonds like it because, these are restaurants. They understand how this corporation works. But here is a way to get a little bit of extra yield compared to, say, an investment grade corporate bond.
Of course, one thing that we always have to worry about, and investors should worry about, is when we see these trades, is really the review of the quality, right? So when you see that whole business securitization, for instance, who's actually doing the analysis of all parts of that business and how secure it is. I know that there are parts of, for instance, the CLO market where we were starting to see kind of vagueness on what was being bundled together, which is eerily familiar. Are we worried about the level at which we're seeing kind of lack of clarity?
Right now, I think investors are definitely being cautious on sort of areas like CLOs. Generally speaking, we're seeing a little bit more investor compensation. So spreads are widening out in some of those asset classes. And I think that reflects just a little bit more caution, what kind of loans are being bundled into these deals. And we have seen scenarios where, for example, a company might have really bad earnings and then that loan drops by a lot. And that can be really scary as an investor. It's just sort of have to think, what collateral am I holding and am I going to get paid back in a downside scenario?
What about the fundamentals of high-grade corporate credit? Is there something fundamentally wrong here, or will we still see demand from global investors just fleeing negative rates?
Right. I think when you look globally, U.S. corporate credit is often called the only game in town. It has yield. It's still pretty safe. One of the really interesting things about the trade in 2019 is that people were very worried about those BBB bonds. They thought, there could be downgrades. But companies really stepped up and they said, we want to stay investment grade. We're really going to focus on paying down our debt. And so some of those credit quality concerns that we came into this year with have sort of dissipated.
So just in terms of how much we expect this to be a trend, obviously after a pretty good year this year, what could shift the sentiment around this part of the market?
I think there's a lot of questions out there about trade right now. Those headlines can affect a whole bunch of different industries, so investors are keeping a close eye on that. That being said, they're looking for sort of that continued deleveraging in corporations. And overall, just, strong economic fundamentals have really boosted bonds. And most strategists are calling for a pretty solid 2020. Maybe not the best year since 2009, but, maybe 4 to 6% returns on investment grade corporate bonds. That doesn't look so bad.